What's happening, traders? Welcome to another video. It's Matthew from Live Free Effects. In today's video, I'm going to be covering how I made over $6,000 trading gold and the three confluences that I used in the execution of this trade. As always, it's important to not focus on the money. Understand that the money is a byproduct of the process. Let's waste no time. Let's jump right into the video. So the very first thing we're going to do is take a look at my trading journal. This is where I track essentially all my trades, and it simply just allows me to improve my overall trading performance because I'm constantly looking historical data, my past performance, and finding ways to improve in the future and just improve my present day trading. And this is something I have done for years. I started off just taking screenshots using Excel, but with technology, you have different, platforms that can essentially give you just overall just better ways to track your trades and whatnot. A lot of my trades are, essentially here, and I trade mainly gold. My win rate is 49%, right? 48.98%. My cumulative return on this account has been 100%, as you can see with the equity steep. This goes to show that, ladies and gentlemen, you don't need to have a 80% or a 90% win rate. All you essentially need is to be making more money on your wins than you do on your losses. This particular trade that we're going to be taking a look at today is a long trade that I took on gold, where I had a contract size, 5 lot size, made around $6,490. As always, my broker of choice is Anchor Trade. They are very good, very reliable. If you are looking for a good broker, a reliable broker, Anchor Trade is one that I've been using for a while. For more information, you can check the link in the description. So as you're taking a look at the charts, right, I'm going to be going over the confluences that I use in the execution of this trade. As a trader, I'm a firm believer that you live and die by your decisions. So you being able to make good decisions is important, and your confluences are like your advisors, the people around you who are telling you how to make the best possible decisions. And the three confluences that I use, the very first one is support and resistance. If we go over to the daily time frame, I always talk about past support becomes future resistance. When the market is moving higher, we have price creating higher highs and higher lows. But what essentially happens is once it breaks above the previous resistance, right, that resistance ends up playing as now future support. The same ends up playing as future support. The same thing is likely to happen, and that's just the ebbs and flow of the market from a market structure standpoint. Support and resistance is extremely reliable when it comes to using it as a confluence, and with this trade it was no different. Gold had been pushing higher, and what I did was mapping out my support levels by looking at the past historical levels and seeing that, okay, this was an area of resistance. This was an area of resistance. Boom, we had a couple of touches here, and price has now breached this level. So the likelihood that the market is going to come back and trade into this level is significantly higher. So I essentially mapped this level, and what you can see here is this is not just one level, right? Because a lot of traders might think that support and resistance is just one line on the chart. Oftentimes it's not the case, right? It can be a range, an area where price is likely to bounce. And while price is in that area, your job is to be patient and wait for price to do something, to make the first move. What I essentially did after mapping out this area is I just watched. I watched the market. Boom, we saw the first big push. Price pushed higher and consolidated a little bit. I actually was sitting there watching, waiting for this trade, and we had news that day at 8:30 and price took off. I ended up missing this opportunity. I was a little bit disappointed. You're gonna have these experiences as a trader. You're gonna miss opportunities, but don't worry, more will come. So I ended up missing this opportunity, and price essentially took off. I didn't complain. I waited, price continued to move higher, and then we had more sellers come into the market. After paying attention to my support level, right, and resistance, and knowing that, okay, this is working, as the market came down, right, more sellers came into the market, right, we had a little bit of a pullback. So the next confluence that made me execute this trade was understanding who is in control of the market. Ladies and gentlemen, before you take any trade, that is the main question you should be asking yourself. Who is in control of this market? Whose market am I coming in? And the best way for you to identify that is through market structure or observing the volume and momentum in the market. Market structure is an easy way because I've talked about it in multiple videos, because when buyers are coming into the market, they're making higher highs and higher lows. And when sellers come into the market, they start to target the lows, right? And this change causes just essentially the control to shift, because now you have sellers coming into the market and buyers are essentially no longer dominant. If we take this out, what we can see on this trade here is that sellers were dominant, making lower lows and lower highs. They were dominant up until this happened. We got the big push. We're at a critical support level and price bounced. So this was the first sign that now buyers are looking to come into the market. So now we had a higher low form, which is another signifying factor that, hey, you know, buyers are now coming into the market. Over here, we had a break in structure and sellers essentially took out the low. So this is where a lot of traders will say, wow, Emmanuel, this is a signifying factor that we're going to be seeing more sellers come into the market. That's not always the case if you are looking at the detail. Ladies and gentlemen, I believe that outside of market structure, the candles are the next best thing because they can allow you to follow the money. If you're looking at the market right here, what you can see is the size of each candle. We have two candlesticks right here, and what they signify is, boom, a lot of volume, that buyers are coming in strong. And what you can see here too is the same exact thing. We had two candles that were very, very strong and very dominant. For me, when I'm trading or I'm looking to execute a trade, I am a visual person. I like to picture, okay, what is the possibility of price breaking lower? Okay, we had this little pullback. What is the possibility of the market essentially continuing downwards? It just didn't make sense to me because these candles were so strong, were so dominant. So as a trader, when you're looking at a break of market structure, what you have to pay attention to is that, hey, you know what? Even though we get a break of market structure here on the 1 hour time frame, these candles are very dominant still. That means that more buyers are likely going to come into the market, and this is essentially what you just call stop hunt, or price seeking more liquidity to continue its push to the upside. The next confluence that was used in the execution of this trade comes in a form of a question. Where is price reaching for? As a trader, before you take any trade, it is important to know where is price reaching for. And if you follow step number 2, which is identifying who is in control of the market, it is generally relatively easy, because if you know that buyers are in control of the market, and yes, we have this dip to the downside and price is essentially right here, we know that buyers are likely going to still continue targeting the high because they are in the market. So the concept of liquidity can be used to answer this question, because when buyers are in control, they are targeting the liquidity at the high. If you take a look right here, the same thing happened, right? We hit the support level, the market pushed to the upside, taking out this high. Okay, price consolidated a little bit. Where was the next target? Boom, right? This high. And always observe, after the market takes out an area of liquidity, we get a pullback, we get a retracement, because its objective, it signifies that its objective has been complete. Ladies and gentlemen, I don't make this up. I'm not making this up. This is a phenomenon that happens in the marketplace. And if you study the market or you study price action, you will see it as clear as day. Right? And it's essentially right there. Before I took this trade, the question that I asked myself is, where is price reaching for? I know I want to be a buyer. So what that means is, if I want to be a buyer, I know that there's a strong possibility that price is going to be reaching for this high right here. And it is the easiest objective for price to hit. And from where price was when I took the trade, we had approximately 80 to 90 pips worth of take profit. So for me, that also allows me to quantify my risk to reward. Like, wow, is this worth it? Because if price was reaching for the next high and it was maybe only 30 pips away, I might reconsider. Like, if this is the main big objective, I might not want to take this trade. So I noticed that, okay, we had from where price is to where price could likely reach for is, essentially almost 90 pips. The trade played out for almost 130 pips. When I closed it, just being able to answer that question gave me a much needed clarity. If we go over to the 15-minute time frame, another thing you can also do as well is you can use your fibs. For me, I like to use fibs as a way to just see if the area that I'm aiming for kind of fits the fib extension, because if you are using your fib extensions will help you identify areas of liquidity. We have the 1.618, which is, you know, the main extension, and you also have your 1.27. But once you start to understand just the highs and lows, you're not going to necessarily need the fibs. So a lot of the time I don't use fibs, but if you're new to this concept or just new to the concept of like price reaches for the highs, buyers reach for the highs and sellers reach for the lows. So when you're targeting, you're placing your targets, you want to target these highs. And also when you're placing your stop loss as well, you generally want to try to place them, you know, at a low or at a high, depending on whether you're a buyer or seller. But a way to just, okay, in this case, if I'm being a buyer, right, to see where is price likely going to reach for, so I know where I should look to get out of this trade, we can see that my line is not straight, right? But the 1.618 fits perfectly. It is literally right there. That's what your fibs do. Your fibs help you identify areas of liquidity that price will gravitate towards, right? That's just simply it. So I looked at it, and this is an area of liquidity. I'm going to take this trade, and this trade was taken in the London session because that I normally trade in New York session, and it's bedtime, like it's nighttime for me. I saw the opportunity, and essentially I gave myself a little bit of a breathing window to see where price would essentially go with this trade. That's essentially what happened, right? We ended up breaking above this high. We took profit pretty much at 130 pips overall, and you know, it took just a couple of hours, right? It didn't take too long. It didn't take an entire day, and that's just simply it. Just to do a quick recap on the trade in terms of Confluence that was used on this particular trade: support and resistance. Past support becomes future resistance, and past resistance becomes future support, as it did in this case, right? And it's important to know that a support or a resistance level can be multiple level, or it could be like a wide range, right? It doesn't have to be just one line on the chart. This, you know, was a little bit of a larger level, and it was taken from the daily time frame, right? So always get your key levels. Try to get your key levels from higher time frame. The next Confluence that was used is understanding who is in control of the market, and the way you can understand who is in control of the market is using market structure. As buyers are coming into the market, they're making high highs, higher lows, higher highs, and higher lows. The next thing that you can do to identify who is in control of the market is paying attention to the candlestick, because the more volume there is in the market, right, or in a particular candlestick, the stronger the move is, and that tells you how dominant the buyers are. If buyers are coming in and it's only taking them 2 candles to hit essentially like 200 pips worth of move, right? This is almost 300 pips worth of move. It tells you that, hey, there's a lot of money in this candle, right? So candles allow you to follow the money or the liquidity that is flowing into the market, and the stronger the candle, the more dominant buyers are. And the tool you can use to identify where price is reaching for is fibs, because the fib extension will kind of give you an overall understanding of where price is reaching for. So especially if you're using the 1.618 extension or the 127 extension. And that's the video, ladies and gentlemen. Thanks for watching. Hope you found this video insightful. As always, if you have any questions, feel free to leave a comment down below. On your way out, don't forget to hit that like and subscribe button. Till next time, I'll see you in the next video. Cheers.